Good afternoon, I'm Greg Strachan, private broker at Emperor Asset Management. Today I've got with me Charles Savage, CEO of Purple Group. Thank you, Charles, for joining me.
Thanks, Greg. Nice to have you out.
It's an absolute pleasure, and thank you for your time. What I thought I'd do is I'm going to be doing an interview series to give you guys an idea of where we're going as a company and an update as a whole on some of the products and the vision for the company. So one of the first things I wanted to ask Charles was, Emperor's obviously come a long way since our humble beginnings in 2011. Share with us and our clients the vision for Emperor and also where it fits into the overall Purple vision.
Cool, Greg. As you say, it's come a long way. You've got to look at the industry as sort of two parts right now. The first part is the traditional asset management industry, which everyone is aware of, which is a trillion rand kind of industry and where the focus has been for the last 30, 40 or 50 years. The second part of the industry, which is really where we fit in, is what they call the alternative space. And PwC came out with a report last year which we sort of concur with and which we recognized back in 2011, is that alternatives will become mainstream in the near future. And we're predicting that by 2020 the word alternative will be dropped and the kind of investing that we do today will become much more mainstream. And so really what we're trying to do is position ourselves as one of the top 10 managers inside the alternative space so that we inherit the new normal space where those two things, alternatives and traditionals, become one. And that's an exciting prospect because there are only a few names that have really put their hands up and put the name on the door. There are two or three managers that have already created their brands and established their businesses. But we highly differentiated to the extent that, one, our strategies are momentum biased and quantitative, which separates us significantly from the rest of the market. But two, we're the only alternative manager that owns the client, that goes out and acquires its clients and owns that relationship and is transparently communicating with them every day. And so we're hell of excited about what the prospects are for asset management. We agree with PwC. We think alternatives will be the new way to invest, and we're going to ride that wave and make sure that we deliver investment excellence all along the way.
Do you see Emperor playing a large role in Purple's forward growth and the vision of Purple as a whole?
Yeah, it already is. I think you need to read the annual report. You probably have. And I think in the annual report it was about a year ago, so last annual report 2013, it was about 5% of group revenue. This year it was about 25% of group revenue. And my expectation is that within the next 2 years it will completely cover our cost base, which means everything else we do will return to our bottom line. And that's not blue sky kind of thinking. That means that we need to be about 4 times the size we are today. And given the fact that we're growing the business at 30-40% per annum, we're not far from doing that. So is it going to play a significant role? For sure it's going to play a significant role. It's a big part of our future strategy, and we're certainly going to continue to invest alongside our clients in making sure that business grows and is an important part of what we're doing in the future.
Fantastic, man. I think a lot of the clients will be very happy to hear that. Now, so to back up what you're saying, there's, recently we've launched quite a few new products which a lot of our clients may not even be aware of just yet. Maybe talk to what they are, not in too much detail, and how you see them sort of fitting into clients' portfolios, and where clients can maybe look at diversifying out of Robert Falcon Scott potentially, or even out of the other traditional funds that they might be invested in.
Yeah, I want to start by saying that the industry has got too many funds for such a small investment universe. 800 unit trusts and a whole lot of other alternative strategies, all focusing on 400 shares. And actually, when you slice and dice it, they're focusing on about 100, 150 shares. So it's a crowded space, and then you say, well, why are we deploying new strategies? And the simple reason is that Robert Falcon Scott catered to a specific segment of the market. We felt it was the broadest segment of the market in terms of its risk-return profile, and so that's the reason we launched it first. Importantly, it had a track record, and so it was easier for us to sell into our client audience. Sure. But having said that, it is a multi-strategy approach. So within Robert Falcon Scott, we actually deploy 3 or 4 other strategies. And in understanding those strategies and unpacking them, we realized that we had some highly differentiated strategies from Robert Falcon Scott that could deliver a different risk-return profile to our clients and extend our offering, not for the sake of extending the offering, but to present different investment opportunities with a different risk-return profile that will perform at different times. And we experienced that in the last quarter of last year. SEH, which, as you know, has been around for 6 months, it was almost 100% different to RFS's returns over that period. And so it just diversifies the offering. At its core, the thing that I think our clients mustn't lose sight of, we deploy the same momentum algorithms, just with slight tweaks to take advantage of different circumstances. So we're not moving away from what we're good at. What we're good at is momentum quantitative-based investing, but what we're doing is deploying in slightly different flavors to meet different risk-return profiles. And I've got to tell you, I sell Emperor, as you know, I sell investments, and I've got to the point now that when a client walks through the door, it's very rare that I'm not selling him the whole suite of investment products. And the only time I'm not is if he's not already invested in unit trusts. Then I find it difficult to motivate why he should move to our unit trust. But where clients have got unit trusts and want slightly less risk or slightly higher risk, or a longer term objective versus a shorter term objective, I find I sell the whole suite of products. The diversity is definitely adding to what we can offer our clients, and I don't think there's a client out there who couldn't benefit from exploring some of the other funds that we've got to offer. I can tell you now that they are the result of tens of thousands of hours of research that Tom did, and in some of them, I think some of the best work he's ever deployed. And I'll talk about the unit trust for a second. In all of our other strategies, Tom's had the luxury to use derivatives to create outperformance as well as to protect the fund. So he could gear the portfolios. When it came to the unit trust, he no longer had the ability to use derivatives for that purpose. So he couldn't use it to gear up the portfolio, and he also couldn't use it to protect the portfolio. He couldn't buy puts and calls and things like that. And so he had to think differently about how he was going to create performance. And my mandate to him on the unit trust was I want the highest performing fund at the lowest risk, which is like, come on, Charles, give him a chance. But what he has delivered in return is exactly that. In my view, and it's only been 4 months, the fund is, well, not in my view, but in the experience, the fund is performing really well. I think it's about 6 or 8% ahead of the market over the first quarter. But in my view, and time will test this, I think he has created a fund that has the opportunity to perform at the highest levels, rank in the top 5 in this country, whilst presenting the lowest possible risk. And I'm really excited about that prospect. He had to use equities only, and so he's had to come up with different ways to invest in equities and different styles of momentum. And it's hard to explain in a short video, but I can assure you and our clients that if they go look at the short track record, which has got to be the most volatile period that we've experienced in the last 5 years, and you go and see how well that fund has performed against its benchmark, it should give them some confidence that the work he did is paying dividends.
Fantastic, and that's actually good to hear, because obviously from a client perspective, I think to summarize that, as Charles is saying, there's place for you to have investments in all of our products at different levels, because they all play a slightly different role.
Yeah.
Probably Robert Falcon Scott playing a larger role in that because it's got a longer track record.
Yeah.
But you can sort of diversify your risk exposure through our product range, and that's only going to be expanding as we go, which is very exciting.
That's exactly right. I think the expansion is going to focus now on international. So there's so much that we need to do in South Africa, and I think that I'm not saying we're done, but I think that we've probably done 80% of everything we're going to do in South Africa. We are working, which is interesting, on one more South African fund, which will be a 2-manager strategy where we combine fundamentals with quantitative analysis. Okay. And the fundamental manager is a black manager by the name of Umfa Mali. We're hell of excited about what that prospect could bring us. That'll hopefully launch within the next 6 to 9 months, and so that'll probably take us to 90% of what we want to do in South Africa. But Tom's focus for the next 6 to 12 months is focusing on taking the strategies that he's developed here in South Africa and applying them to the US market, because there are significantly more opportunities there than there are here. We're focusing on a market universe or a stock universe of 100 to 200 stocks. The S&P 500 is 500 stocks, all of them deeply liquid, all of them interesting investment opportunities. So we're not going to focus heavily on more funds for South Africa. We are going to focus heavily on deploying those strategies now in the US. And hopefully, if we're on time and Tom gets through the work in the right amount of time, we'll be able to deploy those still this year. But we're not going to rush it. When he's ready and he's done his homework, the funds will be ready to go.
Well, that certainly is quite exciting, because a lot of people have been asking me when that's going live, and we've been working on it for a while now, so that's a very exciting prospect. Let's move on a little bit more to current times, and obviously Tom's just released his latest review, and as we know, the volatility in the market has been rather high. I think the volatility index almost doubled in the last 2 months, I think mainly because of the oil price as well as the Swiss sort of unpegging themselves from the euro. So maybe just talk through our strategy going forward now, to take into account that volatility and protect clients if we need to.
Yeah. You know, I said at the beginning, my New Year's resolution this year was not to make any predictions until we get to February, and that was probably a little bit it was a little bit chicken of me, because what we've had in the first 2 weeks, we're just coming out of a period of extreme volatility, growth in volatility, as you said, 100% growth, and then we were entering a period of extreme uncertainty, especially around ECB. The Swiss was left field, black swan kind of event. No one would have predicted it. And we don't invest in currency, so there's no effect on us. But you know, we saw brokers in the UK go under as a result of it, and hedge funds. But the ECB meeting's been in everyone's calendars for a long time. There's been a lot of anticipation around and speculation around what Draghi might do, and in fact, to the extent where everyone had sort of felt that they'd guessed what he was going to do. And the concern for everyone was, what happens if he underperforms, or in fact even overperforms? What are the risks that will ensue? And that saw a lot of extreme volatility start off January, more volatility than I've seen in I don't know how long. And what that led Tom to review is, what kind of strategy do we want to deploy whilst this volatility exists? And his market update coherently describes exactly why we put on we hedged. You asked earlier why we didn't use put options this time, and quite frankly, they were just too expensive this time. And so shorting the index by virtue of shorting Satrix was a much cheaper option, much more beneficial for our clients, and so that's what we did. And also de-geared the portfolios. We're able to sit here with a little bit of hindsight. So Draghi, as we know, spoke yesterday. He gave a lot of comfort to the market, and since then the market has rallied. And you know, as our clients well understand, and you too, it's a dynamic marketplace, and so we've got to be able to respond to what happens in the market when it happens. And since Draghi's spoken, and given the fact that the market has moved so strongly afterwards, we're again reviewing the market review. And I would expect that we're going to have another market update to our clients this evening. So it's Friday today, and our clients should get something this evening, updating them on our response to what Draghi had to say. And you know, that's how dynamic we are as an asset manager. You know, Tom's as invested as any one of our clients, so the market moves, he feels as much as everyone else, and importantly, it draws him to action. And so he watches these events. He's always anticipating what might happen and taking preventative measures to ensure that we don't take on too much risk into them. At the same time, once they've occurred, he's looking to take advantage of that opportunity to ensure that we get the maximum return. So yeah, volatility, heightened concerns, which really just put us in a position where we wanted to see the events unfold and not try and predict too much about what's going to happen. Now that they've unfolded and we're aware of what Draghi's going to do, our view is that volatility should dissipate to some extent, and we can get back to good equity returns.
So in a nutshell, then you'd say to clients that the probability of a downward drop as per the last review has sort of dissipated quite a lot.
Yeah, it's diminished. I mean, oil is the proverbial sort of outlier at the moment. I mean, oil has so I read a research article, we're the third biggest benefactor in the world of low oil prices. So it has a very positive effect for us. But South Africa also relies on strong US equities. And the S&P has got a huge concentration of big oil companies. And so when oil prices go down, the S&P goes down. So oil's the outlier for me. I think lower oil prices in the global outcome will be good for equity markets. In the short term, I think it could continue to cause some volatility. But if we see sustained oil prices around $40 to $50, even up to $60 a barrel, I think that South Africa's got to get a Joe card for our GDP. I think we'll get a 2 to 3% upliftment in GDP as a result of low oil prices. That's going to be great to give investor confidence in equity markets. And ultimately, I think it's going to be good for Europe, who's whilst they're looking for a catalyst for inflation, part of that inflationary requirement needs consumers to spend. And oil, more than anything else, puts money in the consumer's back pocket so they can go out and spend. Despite what Draghi's done by throwing a whole lot of cash at the system, that money doesn't get to the investor. It doesn't get to the client. I think oil does. I think the reduced oil prices put more money in your pocket, and I think you might find that whilst oil prices seem on the face of it to look like an anti-inflationary move, I actually think they might be the catalyst for higher inflation and therefore a recovery in global equity. So I think it's going to be a good year. I think volatility will dampen from where we've just come from, but certainly be higher than last year overall, because we had a strong trending market all the way to September and only got volatile in the last quarter. So I think overall we'll have a little bit more volatility, but I think it's going to be a good year for investors, and I'm glad Draghi's behind us, and I'm looking forward to February.
Fantastic. Well, that's very good news for our investors. Now, the last question, which is actually quite appropriate, talking about Tom, is I get this question a lot. What happens when Tom leaves?
Yeah. So I mean, I've got to go back to when I started the business with Tom. That was my first question. So what, Tom? We're going to create this business, but then what happens when you go? And it would have been foolish of me to invest in a business where the main guy's exiting in terms of the asset manager. And so what Tom convinced me of then and now, and it's demonstrated in who runs the fund now, is that he could teach other people to do this, because it's quantitative, because it's maths based, and it's systematic. Monkey could do it. It's not quite that simple, but that's what he told me. Now, since then, we've been training a whole lot of guys, as you know, most importantly TC, to do what Tom does. And importantly, for the last 2 years, TC's pulled the lever on every single transaction across every single fund. Now, he has the luxury of Tom being there, but Tom's been working on new strategies, new funds, and he's been deploying those, and TC's the guy managing the funds every day. So, it's not about Tom anymore. Tom's intellectual property is irreplaceable in terms of creating new funds, and that's why I want to sweat that now, while we still got him. But in terms of the management of the current strategies in the current funds that we've created, that's monkey work, and TC's a lot more capable than a monkey. So I'm very comfortable that we've got that covered. We've got good graduates who are working and supporting TC, and we'll continue to have more people looking at that than just TC and Tom.
That's fantastic to hear. I mean, is there an exit strategy for Tom, or has that not been defined yet?
No, there is. It has been defined. 2017 was the date that we agreed. In a strange kind of way, I don't think Tom will ever exit until he sort of exits. And you know what I mean there. I think Tom is creating a legacy here. And I think he loves that. I think that's part of his mantra. He gets out of bed because he wants to make a difference for people in their lives. And he's doing that in a big way now. And I think he's going to find that very hard to leave behind. And so I think we'll always have Tom, always, until he passes away, which, who knows when that's going to be. I don't think he will ever formally exit. I really don't. I think he gets out of bed to make a difference in people's lives. He gets out of bed to beat the market. And those things aren't going to go away. He's going to always be invested in this fund. He's always going to be around. But at the same time, what we're going to do is reduce the load so that he can spend some time enjoying cocktails on the beach somewhere.
Well, that's very comforting to know. I mean, as me as an investor as well, certainly does help the concern that people have had, and it's great that we've got that now. Guys, that's the end of the interviews. Charles, thank you so much for your time. We really appreciate it.
We must do this more often, man.
Yes, certainly. And guys, please, we're going to look out for more interviews like this. I'm going to be doing this monthly, so hopefully you add value. Please send us some comments and feedback on these interviews. We really want to add some value to you in a different format, a more media-orientated format that you can understand. So thank you very much, and let's hope for a fantastic 2015.